In my market outlook last year, I've highlighted that 2022 will be a rough year ahead, and as expected, 2022 was a rough year for all investors. In 2022, investors have to deal with the impacts of the Russian-Ukraine war, China lockdowns and COVID-0 adherence, high and stubborn inflation rate as well as the rising interest rate environment. And as a result of this ever-changing environment and highly uncertain future, investors' confidence is badly affected, and investors are rushing for the exit, thereby causing almost all asset classes to register major losses in 2022. And of course, our portfolio is not spared. In this video, I'll be going through number 1, how the funds that we have invested in had performed, number 2, previous actions that was taken and future actions that is expected, number 3, a deep look in the fundamental analysis and the expected annual returns of our investments, and number 4, market expectations moving into 2023. Without further ado, let's get started. Portfolio funds performances. In 2022, all the funds that we had invested in had registered losses, with equity funds registering double-digit losses, which are in line with how the other major indices such as the S&P 500 have performed. That said, on a portfolio level, the losses that we've suffered last year are mitigated largely by the action that was taken 2 years ago, and also the fact that we are investing based on a dollar cost averaging basis. Personally, here's how my portfolio had been performing. For individual performances, please refer to your own investment account as a return may vary depending on when you start investing and also the extent of which you follow my actions when we bought the dip last year. And that brings me to the next topic on actions taken. Actions taken and potential actions ahead. In anticipation of the poor performances last year, we had previously sold off half of our portfolio back in July 2021. The amount that we sold off is then broken down into 3 parts and to be reinvested back into the same funds that we are using when the prices and the valuations of the market had came down. That's it. If you've only started investing with me in 2020 or 2021, these portfolio actions do not affect you due to the limitation in the portfolio size and implementation. As prices had came down last year, we had currently invested the first 2 parts of the funds that were previously sidelined, which accounted for 60 to 70% of the total amount of the funds to be invested. For the remaining 30 to 40%, I expect them to be deployed moving into 2023 should the fundamental situation improve or the price decrease further. Thus far, the fund that we have reinvested in is only limited to the Asian equity as the valuations are attractive in the Asia region given how beaten down it is. As for the global equities, the valuations are somewhat neutral and not attractive enough yet for me to consider investing in it on a lump sum basis. But we will be rebalancing our allocation again as the market normalizes moving into the later half of this year and perhaps sometime next year. Fundamental analysis and future expected return. On the topic of fundamental analysis, from the angle of the price-earning ratio, we'll be looking at the global equities as represented by the S&P 500 and the Asian equities as represented by the MSCI All-Country Asia Pacific Index. For the global equities, valuation had came down to its long-term average given the anticipation of an earnings recession this year. That said, if we were to examine the price and earnings behavior individually, what we will realize is that the earnings for the S&P 500 companies are still going strong, while the fund prices are pricing in more pain to come this year. What this means is that moving into 2023, we can expect more pain to come for the S&P 500 as in order to sustain its current valuations with a low and lower earnings figure, prices will have to adjust downwards. Looking at what is in store for the global economy, it is likely that we will experience an earnings recession this year and hence more pain is expected for the S&P 500. For the Asian equities, valuation had continued to remain depressed at the back of China's lockdown and deteriorating investors' confidence. Currently, the price-to-earning ratio is trading below its long-term average, which is very attractive given that things are changing for the better this year as China moves towards complete reopening and achieving herd immunity. Looking at the earnings and price behavior, while the decline in the fund prices is not fully unjustified, I feel that the extent of the decline is over-exaggerated as a result of mass panic and exit away from China and Asia market last year. While the earnings may continue to experience a decline as a result of a slowdown in the global economy, the depressed valuation will provide a strong case for further upsides in the markets. What is missing for a recovery to occur in Asia is a strong investor confidence, which eventually will recover as the global economy stabilizes. Now that we've understood where the two markets stands in terms of valuation, the next thing that we will be looking at is the projection of the performances based on the outcome of my relative valuation model. To smooth out any short-term volatility and noise in the data, a 3-year rolling average data will be used for the calculation and projection of the earnings per share. For the global equities, based on the earnings per share growth rate of 4 to 6% and a fairly value market environment, the expected annualized return over 5 years is 1.2 to 3.5%, while the expected annualized return over 10 years is 2.58 to 4.55%. For the Asian equities, based on the earnings per share growth rate of 6 to 8% and a fairly value market environment, the expected annualized return over 5 years is 9.4 to 11.5%, while the expected annualized return over 10 years is 7.7 to 9.74%. From the above findings, it is clear that the expected annual returns are pretty decent for the Asian markets, as investors are able to buy into the future growth of a developing region at very low valuations. Therefore, the expected returns by investing in Asia now is driven by both valuations and earnings revision that will happen as we revert back to long-term average levels. On the other hand, for the global markets, as the market is already trading at its fair valuation, investors who are buying into the global equity at this price will only be able to earn a return from the fundamental growth itself, which is expected to be lower than the Asian market, as the global market comprises mainly of developed markets that are unable to grow at the same pace as the developing market itself. Portfolio expectations moving into 2023. While the future expected returns looks decent, I do not foresee them materializing anytime soon, at least not within the next 18 to 24 months, as I expect the markets to remain depressed as a result of the headwinds that are caused by the stubbornly high inflation rate and the rising interest rates that is driving the global economy into a recession. On the topic of when would the market stop falling and start recovering, this will only be possible if investors' confidence recovers, which I've previously done a video on, as well as a detailed sharing of my market expectations for this year. The links will be in the description box below, so do check them out if you want to find out more. If you have any question pertaining to the portfolio itself, do PM me and we can set up a meeting online to address any questions or concerns that you may have. Hang tight for the recovery, and I'll see you in our next annual review.